Welcome to The Explainer. Today, we're going to pull back the curtain and show you exactly how a professional market analyst looks at a financial chart. We're going to break it down step by step and see how they transform what looks like total chaos into a clear, compelling story.
Okay, let's just dive right in. What you're looking at here is a chart of a popular S&P 500 ETF. Now, for most people, this is just a jumble of red and green, a squiggle that seems totally random. It's kind of intimidating, right?
But here's the thing. For a trained eye, this isn't noise at all. It's a narrative. It's got characters, a plot, even moments of high drama. So the real question is, how do you learn to read that narrative that's hiding in plain sight?
Well, an analyst's very first step, before they do anything else, is to figure out the overall context. You have to understand the main plot of the story before you can possibly understand the scene that's playing out right now.
And in this case, the context is, well, it's immediately obvious. The analyst's first take is that the market is clearly bearish. This isn't a guess, it's just an observation of the dominant force at play. It's what's called a classic trend day down, basically a day where the sellers are in complete control from open to close.
And watch this. You draw one simple line and boom, the story's direction becomes crystal clear. This downward trend line just confirms that bearish narrative. From this moment on, every other piece of information gets viewed through this lens. The expectation is set. Sellers are running the show.
Okay, now we get to the single most important event that the analyst spots on this chart. This is the story's big turning point. This is where the plot really thickens.
The entire story today, it revolves around this one number, 66.50. Now, this is not a random price. It's yesterday's lowest points. And in trading, old battlefields often become the new front lines.
So why is this number so important? Well, at first, that 66.50 level was acting like a floor, what traders call support. You can see how the price came down to it and just bounced. It couldn't break through. That was the buyer stepping in and holding the line.
But then, the floor broke. And after a really powerful break downwards, that same level has completely flipped. What used to be a floor is now a ceiling or resistance. And psychologically, this is a huge deal. It means anyone who bought at that floor is now losing money, and they're probably looking for any chance to sell and get out. So that old support becomes a brand new wall of sellers. It's a classic plot twist, confirming the bears have taken over that critical territory.
So, with the market now clearly below that key level, we're going to zoom in on what's happening right now. This is the current moment of tension in our story. A pause in the action. But is it a reversal, or is it just a rest stop? This is where pattern recognition is just so valuable. The analyst looks at this little pause and immediately identifies a specific, well-known formation, a bear flag. It's called that because it kind of looks like a flag on a pole, and it usually shows up in a downtrend. And it signals not a reversal, but a continuation of that trend. And this is just a perfect example of how analysts find order in what looks like chaos. What seems like random, choppy movement is actually a very structured pause. A clear bear flag pattern forming right underneath that critical 66.50 resistance level. So the analyst's interpretation here is absolutely critical. This pause is not a sign of strength. It's not a bottom being formed. No, it's seen as a strategic regrouping by the sellers. They're basically absorbing the last little bit of buying pressure, kind of catching their breath before the next big push lower. So, we've got the big picture, we have the key turning point, and we have the current pattern. Now what? How does all of this analysis get translated into a clear, unemotional, and actionable plan? Everything, and I mean everything, flows from this one core belief or thesis. Based on all the evidence that we've just walked through, the story is clearly pointing in one direction. So the entire plan is going to be built on the high probability expectation that this downward story is going to continue. And that thesis leads to this just beautifully simple three-part plan. Part 1, the core belief. The downtrend continues. Part 2, the specific opportunity. You enter a short position if the price breaks below that flag pattern. And Part 3, just as important, is the escape plan. If the story turns out to be wrong and the price gets back above 66.50, then the whole idea is invalid and it's time to get out. So what this does is it highlights the two clear outcomes that the analyst is prepared for. There's no guesswork here. Either the story unfolds just as expected with the breakdown, or the plot twist happens and the price reclaims 66.50.
By knowing both of these potential endings ahead of time, the analyst removes emotion and is ready to act decisively no matter which way it goes.
And that really is the core lesson here. We started with this confusing, noisy chart, but by learning to read the market's story, by identifying the plot, the key turning points, and the patterns, all that chaos was transformed into a clear narrative with a very clear plan. And that's the difference between guessing and analyzing. It's how you turn noise into a signal.